So, tutorial 1 of understanding basic accounting, I want to explain what an asset and a liability accounts are. In accounting, there's also the owner's equity account, but because it's a little confusing to start off with, I'm just going to just skip it for now. So, in accounting, there's the asset account, and an asset is something that is owned, like cash, the land that you own, supplies like erasers, rulers, all that stuff are assets, and assets are debit accounts. I'll explain that later. A liability is something that is owed to someone. So a bank loan, account payable would be a liability, something that you have to pay off to someone else. An account payable is basically money that you owe to someone, and this is a credit account. I'll explain that later too. So a debit is what you own. As debit goes up, the value of what you own goes up. So in this example, I have my bank asset, and it currently has $100 in it. If I add an additional debit of $100, then my asset goes up, and I have $200 instead of $100. Same on the credit. Credit is what you owe. So as credit goes up, the amount that you owe goes up. So if I had a bank loan that had $100, so that means I owe $100, and I added a $100 credit, then I would owe $200 because what I owe would go up by $100. And then there's advanced debit and credit, and that's basically when you use debit and credit to modify assets and liabilities, like to lower them. So basically, debit is a positive number because you would look at cash as a positive value. Credit is a negative number because you would look at a loan, something you owe to someone, as a negative number. So looking at an example, imagine if I had a bank asset that had $100, and because it's an asset, it's a debit account. Imagine if I were to spend $200 of the account. I know that's not technically possible, but imagine if I were to do that. Then my debit would be negative $100, and because once my asset goes below zero, it becomes what I owe. If I were to have $100 and I spent $200, then I would owe $100. So then negative $100 in debit can also represent $100 in credit, because in both aspects I still owe $100. Same thing on the credit side. If I had a liability, if I owe the bank $100 and I were to pay it off, technically, because credit values are technically negative, the number is actually negative 100. It's just by saying credit, you're basically saying negative 100. And say I were to pay $200 into this account, my credit becomes negative $100. And because when you pay off more than what you owe, the remaining money becomes an asset, my bank loan is now a debit account. I have $100 of an asset because I paid off my $100 loan and I have $100 left over, so that's an asset. And then there's minor changes. So from the example, you notice that negative debit values are equal to credit values. So when I have negative $100 in debit, that would also be equal to $100 in credit. As well, negative credit values are equal to debit values. So if I had a negative $100 in credit, that would be equal to $100 in debit. So because of this reason, credit values lower assets, lower accounts are on the debit side, and debit values lower liabilities. Liabilities are accounts on the credit side. So here is an example. So say I had a bank that had bank account that had $100, $500, and it is a debit type. If I were to spend $250 of it, I would have a debit transaction of negative $250. And because negative debit values are equal to positive credit values, this is equal to $250 in credit. So both options, $250 negative $250 in debit, and $250 in credit, would both decrease the bank asset by $250, and in the end, in your bank asset account, you would only have $250. Same on the bank loan, which would be a credit account, because it's what you owe. Say you owe $500 to the bank, and you were to pay off $250 of it, that would be negative $250 in credit, and because a negative credit value is also equal to a debit value, this is also equal to $250 on the debit side. So both options will pay off the bank loan liability by $250. So now, if I were to apply either one of these transactions to my bank loan credit, now I would only have $250 worth of bank loans that I would have to pay off. And the final example is totally forgetting the negative. So if I had a bank asset that was a debit with $100 in it, so that would be, I had $100 in my bank account. If I were to apply a credit of $50, then that would be a debit of negative $50. So my bank account would only have $50 because 100 minus 50 is 50. If I were to put on an asset of $100 or add $100 onto my account, being that debit of 100 would be positive 100, then my debit account becomes $150. Same on the credit side with stuff that I owe. If I had a bank loan that I owed $100 to the bank, then if I were to apply a credit of $50, that would be a credit on a credit, which would make it $150. If I were to pay off it by $100, which would be a credit of negative 100 or a debit of $100, then my credit will only have $50 left in it. And just a final note, because technically debit represents positive numbers and credit represents negative numbers, there should be no actual negative numbers written in the logs. You should not see negative $250 of debit. It should say $250 of credit, just as you should not see negative $250 of credit. It should say $250 of debit. So use debit and credit appropriately so that you don't see any negative numbers in the logs. And the reason for this is because it's hard to balance once you use negative numbers and positive numbers and stuff. And balance is something I'll explain in another tutorial. And thank you for watching.